1 point stop loss. Multiple tries if stopped out with maximum attempt tries of 3. Attempt per trade is to catch 3 to 5 point ranges. Over time load up on large contracts. Trail your stops. Stage 1 is to locate correct projected market profile locations for reversals. Stage 2 is to focus on bid and ask imbalanced with value area jammed to opposite side of your trade direction. If not sure, wait for pullback. For E-mini market S&P model, 7-minute charts are used. Start with 2 contracts. With that, let me hand over to our chief quant engineer to walk you through some examples.
Thank you, Christina. Appreciate the quick summary of the system. So let's walk through some examples of what Christina has established here. On the left side, we have the market profile and the projected levels, which we have invented. So right now you see there is a structure put in place. This is 7-minute chart for ES. That is the recommendation coming from our mastermind group. So these profiles are generated over 24-hour period, as you can see here. So that is the driving chart. So this is happening right now, and we will walk through some examples. So first thing is the context and the projected levels. So before the market opens, you have these levels. So the top thick green levels are the projected ranges coming from yesterday's market profile, and same thing is happening at the bottom right here. So you need to know where are you in context of that range. See here also yesterday. So once they are published, they don't change for the entire day. So for yesterday and today, you must mark these levels and be aware of these levels. We are marking them for you, but as you're trading in the heat of the moment, you may not realize that. So let us now go and see. This is the trade time zone you want to trade in Asia session. Now market is going to be slower. The rules will not change. So we have a context, and these lines you see here are pretty much designed to see the ranges inside this massive range. If the volatility goes much higher, it will pound on these ranges. So our intention should be, when we are close to these ranges, we act and take a bias. So let's take this example. So any example you're taking, first of all, this is your driving chart. Where am I in context of the market profile which is being generated? Where am I with context of the projected levels, maximum ranges? So in this example, if we start from here, that's what it is showing us. This profile is where the maximum trades are taking place. So this multiple bell curves, single bell curve, they have some market profile terminology. Just to keep it simple, just this is the area where maximum interest of trade has taken place. That's why it is shaping up like bell curve. And these areas, we call them C areas. These are the points where there was never any interest or doing any trade for whatever reason. These are actually your rejection levels. There was no interest before. There should not be any immediate interest either when we are trying to approach these levels. Either they will reject back, or they will quickly move forward and trying to get to this harmonic points, right? These harmonic points. So it can go from this harmonic point to this harmonic point with this rejection. So these rejection points can act as your support resistance as well. So this is all too much detail at this moment. There's an extensive process which you have to understand as far as the market profile principles are concerned. So, okay, so we identified that. Now, we also have an oscillator on the 7-minute chart, which is telling us the potential bias of long and short we can take. Because the projected level for this day, it could have gone right here and then jumped up. It could have gone up like this, which is it went here and then came down, right? It can blow up also. But you can see here, these are like 40-point ranges. From here to here, you can see this was a 40-point drop, right? And then when it dropped, it went down where? It went down to the low of the market profile. So these lines which are coming here, they are used for that context and stop loss management. Now, we are not trading this chart. We are trading on the right side. So you understand what this is. So this is what we call as the driver chart, the decision making, the direction bias chart. Okay. So let's say we came in early morning to trade at this point. How will you enter the trade? Now at this point, we will enter the right side of the execution chart to have the least amount of risk management of 2 ticks to 4 ticks, which also means you can also get stopped out, because remember, if you get stopped out 2-3 times, you are trying to catch this 10, 20, 40 point moves, the day's range. Or we are suggesting that you go at least 3 to 5 with multi contracts. Take the first contract out at 3 to 5 point, and the other one you can trail. And you can, so now let's see, this is where you identified, okay, I got to the point where I want to trade. You may have your own system also to do some basic stuff for you. So at this point, we got very close. Now I got to see here or here, I want to trade. So let's say you decide to trade here. You need to have some evidence that the buyers and sellers are coming and supporting your initiation of the trade. This is where the right side imbalance chart of bid and ask is exposed. On the right side, you see, as you know, that the bids and the asks are traded a step delta, which means this 13 is bound to this 55. This 13 is bound to this 30. You can just see bid and ask goes like this, not like this, not sideways, but like this. So what we are seeing is this is a bar which is not telling us what is happening inside the bar right here. But this is, now we are opening this bar in detail and making a decision here what needs to happen. Now you see there's printed green areas, labels, and then the printed red inside the bar. This bar color gets this color if you have multiple of these greens inside a single bar. This bar gets red or orange when you see multiple reds in the same bar. When you're starting off new, you need to understand that this is the imbalance. Who is aggressive? Looking at this bar, who is aggressive inside the bar? Buyers or sellers? We want to go short. Our indicator, if you want to go short, it doesn't matter. You have to make the same decision before you enter. It doesn't matter if your moon is moving X number of degrees, or your ascendant has moved so many degrees, or you have a geometry shape, or you have oscillators or momentum, or you have other ideas. When you're about to make the trade, we are giving you this location context for the next day, giving you the stop loss area. Also, if you're trading short here, this is your stop loss, big one, right? Get close to the level, some line close to that. Then we have this dynamic lines also printed out for stop losses. So point is, when a moment you are about to trigger the trade and you want 2 ticks to 4 tick stop loss, the only way out of it is what I'm about to show you, based on exposing and peeking inside the bar what is really going on. And then one thing also you have to understand is this the yellow boxes inside each bar. They are the value areas. The rule says, first one, look at the left chart where we have market profile projected levels. Understand the market profile philosophy, which are the attraction points, which are rejection points, where are the levels which are projected at the high end, low end, and then other areas where we have various other steps. Think about retracement steps in Fibonacci, but done through market profiling. This is the real supply demand. This is ultimate reality which you are about to witness. Then it says stage 2, once you have made up your mind, stage 2, look at the bid and ask imbalances with value area jammed on the opposite side of the trade direction. So what that means is this box should be on the top side of the bar or the bottom side of the bar, 20% on the top or 20% on the bottom, depending on which direction you want to go. So if I want to go short, the opposite side of that is long. So this bar on which I'm going short, the market value area should be on the top side. Why? Because I'm going to lean on that as a stop loss. So if I go short here, somewhere here, right? If this is the middle, this whole thing is my stop loss challenge. If this is way on the top and I go short somewhere here, then my stop loss is going to be very low. That is the reason we describe that model, that this, if you're trying to go short, it should be on the top side. If you're trying to go long, it should be on the bottom side of the leaning bar. We will go through some examples to understand that. That's what the rule says. They're both running on 7-minute chart for years. Every market has their own balance points. Now let's go and investigate further. At this point, you made a decision to go short, but you have no evidence at this point. Second bar came. Just because your intention, you don't jump into the system. Now this bar, looking at this bar alone, there's no evidence for you to go short. Looks like a huge. Now why these are green? Because the buyers are hitting the ask, hitting aggressively. See the prints on the left side. Sales are on the left, buyers are on the right. So this guy who want to sell, they are not able to hit the bids. Bids are too strong and they're lifting the bid, they call it. By hitting the ask, they're lifting the bid. So what this means, on the right side, when you see aggressive range of huge buyers, what are they trying to do? They're trying to break the C, Charlie, and go to the top side of it. Now there's going to be a competition. There's buyers and sellers in every bar. Now they're trying to either fake it or they're trying to give a wrong impression. We don't know that. We have no evidence of that in this bar unless we do some other analysis, right? So here's the thing. We want to go short. I need to have evidence. So I need some sellers coming in. So the sellers came in here. On the right side, the buyers were hitting very hard and moving the bid up. Sellers took over at this point. What spooked it? What happened? We don't know. We don't know. But people are watching this and doing this real time. This prints inside the bar telling me all this was not continuing in this bar. The next bar, there was no follow through. Great try, just like here. Same thing happened. There was a follow through of 3-4 points, right? 4 points follow through. Here, what happened? Nothing. No follow through. It took the other way around. Okay. Now, when you see this, you're in this area, you have to see some evidence of short. We are trying to solve a problem of the lowest stop loss. That's why this is designed. So, okay, so now what we do, we have sellers showing up. We had the context, we had the thing. So now how do we take short? If this bar closed, it opened here, you can see on the left side, closed here. If I just go blindly here, short, and the close, where do I stop loss? Where's my stop loss? Either here, behind the value area, or here. Still, this is like 1 point and 2 points. And ultimately, it went down a little bit and stopped you out, right? So what do we do? So this is what we call is, this is where we need to investigate the block of buyers and sellers to hide behind. More people who are in front of you, you hide behind them, they'll get stopped out first, and you may be saved from getting stop loss. So in this box, the two biggest sellers are where? 65, 92. Where did market go to retest them? 65, 92 to the tick. So you wait for this pullback. That's the rule. If you cannot make this decision because our stop loss is too high, you wait for the pullback. Now where do we pull back to? I just gave you answer. The block. Now you see this? This is where you have one tick, two tick. Your stop loss is right there. If these guys are blown away, you take a small stop loss. And then will they blow away or not coming into this level is designed by looking at the bar itself, who is coming to threaten their shots. How are they approaching this threat? Look at on the left side. You see on the left side, see on the right side, what do you see? The contracts are dissipating. This buyer showed up because he is fighting. This guy got destroyed by these sellers, took a loss. He wanted to do something and blow up. Somebody's trying to blow up to the top side, and sellers are not letting it happen. Now, this is the game, chess game going on, right? But what evidence do we have? The only evidence we have is the number of contracts, the bids. This guy started an initiative idea. Let's go, buyers, let's go. Let's go, guys, buyers, let's go. The buyers are not coming, following him. So he started this thing. Professional traders are looking at these bars. They're not looking at your chart. They're looking at this. And they have a bias. They have labels. They have market profile. What I'm just telling you, and right here. If there was 46, 70, 80, it will blow up. You take a small loss. 46, 9, 3. No follow through. Once you see this, real time is happening real time, right? At this block level, you had an intention in your mind. You take a stop loss of 3, 4 ticks, go short. And what happens? You got a 25 point win. You can catch it. Okay. So multi contracts go out 3 or 5. Other one you can trail, right? You can trail. So that now you see this is the same philosophy you have to follow at every trade. Okay, let's go with this one. What happened here? Now the evidence should be clear. First, what is driving this? We are at the bottom of this multi 2Bs, they call it, split profile, right? So they're testing highs and lows, the highs and lows of this box. They will blow through this box away, and then they will do the same thing, highs and lows on this buy. See this one? So these are all the market profile principles. So they do the same thing. Go to the run, rotation here, right? 10-point rotation. Now these are 7-minute bars. You don't see 10 points is too much, but this is what is going on, right? And that top is holding. It held. It's holding, sorry, right? So, okay, now let's talk about this other side. Now the rules have been given to you. This is the same thing going to happen to you on this side. This is the only true way to come to that 2-tick stop loss logic. It's impossible to do it otherwise. No amount of technology will get you that point. Okay, so let's apply the rules. I want to go long. Why? My oscillator, my profile location, and okay, and then I'm at my one of the profile levels right here, yellow line. Okay, so areas came very quickly. Okay, now what? Look on the right side. What evidence do you have that buyers are coming there for you to fulfill your desires of long profit? This is sellers, huge sellers are moving sellers here, right? These boxes are orange because sellers took control of this bar. And you can see multiple initiative imbalances, which means buyers were not able to defend their aggression of short. That's why you see red prints here, red prints. By doing this into our level, they have moved this market profile at the bottom 25% of the bar, this yellow box. The market profile has been moved, the value has been moved. Now these are the perfect trades we want to take. Now, if this bar went down here, they pushed the market value on this bar way aggressively down. My stop loss is this range. It opened here, went down here. What happened? We have potential long here. Why? Because of this structure of being jamming on the other side. So this is stop loss right here. 4 ticks. See that? If it comes, so now we don't. That is one part of it. So this structure is there to take your first shot. That's why it says a couple of times. You can try 3 times. You get lucky with this, boom. It could have happened is this guy. Now when this guy happened, he opened here and it closed here. You don't know how will they continue forward down to test this low or not. Evidence is we should be looking at long. It could have happened like this. We were going long and then it came down, right? But we'll evaluate all this quickly. So what is going on in this? Where are the blocks? So now we have this value area pushed on the bottom 25%. Where are my shorts and longs? There are no longs here. All we have is short imbalances coming into the level, and the shorts could disappear. They are the people who want to do breakout short and go to the next lower profile levels, right? So will the buyers come and defend it? We don't know in this bar. Bottom line, when the bar is closed, we are here at this moment, boom. It could have gone down 1 tick and gone up all the way and continued, or it could have gone up first and came down. We don't know, right? But we have to see the evidence. If you think this is a strong level and we want to go take risk, this structure 1 is ready for you to stop loss behind here and go here. So it came up, it may have gone like this, right? So any other evidence do we have? Not in this bar. Okay, so can we look back and see? Well, it'll be difficult to do, but I'm just trying to tell you basic stuff first. We have to look back of these, something stopped it here, right? What stopped it here? The question has to be asked, something stopped it, right? Nothing stops on its own. Somebody, some big boy stopped it, right? So let's see. Now we can look back in time, and there's the block. This, what do you call it, double test, retest, right? This test, we have to go back in time and say, okay, what was there? Now you see this block, this guys who initiated this block of trade is a full of buyer controlled box. These guys were threatened again and they pushed it again. That's the only evidence we see here, right? That's why you have to look back also. Okay, going back to our philosophy, going back to our logic. Now if you are not at that level of expertise, what do you do is you are just looking here, you forgot to look in the back, you don't have the right tools to do it, or it might be many reasons. The Mastermind Club has everything satisfied. So what happens here is, okay, we were not sure, we were confused, we wanted to just look at some evidence. Okay, so your methodology will say, okay, this box is good, I want evidence of buyers coming in. Wait for the next bar. So what happens here? At this bar, the close of this bar will tell you what happened in the bar. You can see here multiple things happened. Now what you can see here, that the sellers has 34.12.2. Sellers went away. 78.34.12.2. The power of sellers disappeared. This can only be made, either you make that decision right away when this bar is open and is rotating. We don't know it happened 10 times up and down. It just went here, boom, one shot up and closed. We don't know that. Not looking at this bar. Real time, we have to check. So let's assume the worst case that it went here and went up and down and up and down and up and down. Or it could be just here open and gone, one shot and gone, right? So in either case, this bar, once it is closed, you are now able to decide two things happen here. The value area is at the bottom. So these two bars, the value area box has been moved 20% lower. So opposite side. So we are going to go long. That means in this reference bar, it should be on the opposite side, which is on the bottom side. So because this is our the trapped people here, right? So there's a lot of philosophy behind that. Plus this bar has published, this is a bullish owned bar. Buyers took over. Now this bar, you have a context. Market comes close to this guy, I will go long. Market comes go to this guy. Now we have a leaning areas where these people, if they are real, they will defend their contracts, right? But this was initiative buyers. So market came here, right? And then there's other evidences of multiple. We have advanced tools which will plot all this from behind as well, so you know the reference points. But if too many lines, you will not be able to understand unless you know the basics. So at this point, market came here. It came down, boom, to the tick to this guy. What are the other? So in this example, we have to take some other blocks. This guy 707, 69, then 47, right? 47 plus 69 is net contracts, right? Plus this is a buyer. Now this is 1 to 4 tick, right? So there's 4 tick of evidence that but a stop loss should be behind this for 2 contracts. This is 3-point stop loss behind this. If you want to just make it a 1-point stop loss or 2 tick stop loss, this minus 2 ticks is right here. This minus 4 ticks is right here. So 5 ticks stop loss is right here, right? So 2-point, 1-point stop loss, you have to have evidence that the buyers are behind you and hide behind those bids and asks which are representative of the direction you're trying to go. And there it is. And you go long. So market comes down, retest. This is the retest model which Christina explained to you. Okay, let's go one last one. Same thing happened here. Now this one is same thing, but now again the rules. Market came down, something stopped it. We know this is double top, double bottom, but you know what is happening inside the bar. There was initiative buyers. That is why double tops and double bottoms work, but the buyers are here, right? So now we need to see evidence of your trading. Okay, this bar is initiative buyers. Okay, then we close this bar. Only thing missing is this value is not in the bottom side of it. But we have market profile level, projected level right here, the red one, right? So we have our projected, we can hide behind that. So when this bar is closed, it could have gone down or it could have gone up and came down. But this bar is still initiatively. Now there are enough 5 buyers and 5 sellers. That's why it's not printing any specific color. But we see initiative buyers are here as well. So the buyers coming here, value area here, market came here, it tried to move down with these buyers. Now what happens here? There's another pattern. These initiative sellers, they are trapped. They are trapped. So this is where they'll be forced to take a stop loss. This is the game. And then for you, as a long trader, because we have evidence that this is a long area for us as far as the oscillator is concerned, if that is the direction we want to go, and this is how we will stop loss. Our stop loss, if you open here, initial stop loss is going to be 32. 8 ticks, 2 points. Closer it gets to this and our lines, stop loss gets better and better. So if you want to hide behind 32 bid, which was aggressive, 1632, these people hit it 32 net, and then they hit more here. So what we do is let it come down a little bit into the bar, close to the bid, and there we go. So right here, sellers try to initiate it, did not get much out of it, right? And how about the loss of power? It's not clear either. So we had 122, 1655. I mean, they did decline, but it should go and decline, half the size. 122, 60, 55, 0, right? Gone. That was not evident. Same thing here. 7, 10, 17. Some sellers are caught here. Okay. So this line was there, and these are the 2 reference stop losses. Closer you get to it, fine. Now, if you wanted to wait and say, okay, hey, I don't know, I want to take another kind of trading, which is like let it go down, and the buy limit is sitting right here. Let it come down, whatever it is doing. If it goes like this, your buy is here. Don't have to worry about it. The only thing is you'll get snipped once in a while if it goes down and snips you and comes down again. That's also a possibility, right? These are all possibilities which can happen to you in real life. So our job of reducing the risk this is the only way of reducing the stop loss risk. Let's do this last one, and I think we'll call it a day. Now this is a huge bar, initiative bar, massive bar. Sellers are like just going crazy, right? One big bar, obviously some news came or something happened here. Big bar, 25 point, 20.1 single bar on 7 minutes, which is fine. So we are showing that we want to go long here, right? We are at the, again, bottom of the market profile. This is market profile POC. And then we have this white line as well. We have other lines, right? So we have evidences of these three lines we will trade. So this time we are going to go in this area. So the areas are identified. Now we have to qualify it. Same thing. Now you should be able to see in under any condition that what we're going to do. So let's do evaluation. Is there any evidence of longs here, longs here, longs here? Here, this is full of sellers going crazy. Some news came. Then this comes here. Now, to have taken short, you got to wait for this guy to come close to market profile and green level. This is the area I want to be. And then I have a block of sellers to hide behind here. Stop loss will be here, short will be somewhere here. It never went there. Now the context has changed. I want to go long. There was no follow through, no follow through. Now it's going right. Sellers are trying. Sellers are trying. Sellers are trying. Here, there's a balance of buying. There's no clear winner. Here, sellers are a little more aggressive. When you're going in the opposite direction, you need to see the buyers. Sellers are showing up. Sellers are showing up. Sellers are showing up. The buyers are nowhere to be found yet, right? So we need evidence. This evidence started showing up here. It showed up here, 890. That's why it is like a balanced bar. Total of this pretty much looks like, there was only one aggressive buyer who tried to show up, catch the falling knife, and then made some money. If he had, he 1,000 contracts is a lot. He got some money, got out. It could be stop loss. We don't know, whatever it might be, but the bids were in panic. Either they're initiating or they're taking a stop loss. We don't know, but this is our leaning point. When we saw this evidence, market came here, you wanted to go long, and behind this, you got stopped out. Precisely got stopped out. Then you waited for it could have gone down, wait for next evidence of buyers. No buyers here. Wait for the next bar. The buyers came up. End of this bar. So there was no trade for 15 minutes at this point. So at this point, market opened again. And now we are going to go back and say, okay, this is, and these are my reference points again. And this one has market profile. This one has 392. I will hide 2 ticks behind it right here. Let it come as close as possible to me. If this is going to be initiated, we are still in the long bias. We still know this oscillator is going to move up. We are at the right location. This oscillator is super strong. So we are making the decision again. We are waiting patiently, staring at the screen, looking at the bid and ask, listening to some beautiful music, and then here it is. Now market opens here. This one closes here. This one opens here, comes down very fast. White came down. Look at this guy. These short sellers, they all trapped. Market should have given them profit, but it did not. These guys were not able to move the market down, and they all either have to take a stop loss. That means the bids will be hit and they'll move the market up, or there'll be new initiators. We don't need to know all those details at this point. So my stop loss is these 2 areas for initiating, and this one is still valid. These 3 areas, this seems like a good box range of 4 points. Come as close as possible to me. I will initiate a long, and then I will take it from there, right? So at this point, market is coming down. We see 200 to 300, 200, 100, right? So this is I'm entering my 4-point stop loss range. I will initiate one trade somewhere in that range. So you should know that and put buy orders right there. Market is here. We don't know it's going to go up and come down in 2 minutes from now or whatever, but this is my range of stop loss. I'm entering something here, right? That's it. You enter here. So you need to enter and take 4 to 8 tick range. Here it is 4 range, and then you're a winner of this trade. So I hope you understand what it takes to be a professional trader and what it takes to be a extremely low risk profile trader. That's how it is. And this is the truth of the market. Then you will ask, okay, what happened in other ones? How do we get if you're in the middle of it? Well, remember this. This is a bullish trend has started. The blue bars are telling you the trend is blue. So if you see a very large bars, we have a large bar principle, which means let the next bar come to 50% of the previous bar. Because you missed that trade, you want to catch it. Right? So those principles are still active. So let's go to that principle. Here was the big bar. What do? The rule says wait for 50% of it. What is going on inside the bar? Huge sellers, buyers. No seller found here. Huge buyers. That's what created this huge bar. All green, 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 green. Started here also. Green, 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 right? 15 minutes of aggressive buying. How do you get in? If that is in the middle of the trend. So if it was right here, oscillator is not telling us anywhere. This is right also. Now this is the peak of it. It can go down from here. It can go up from here. Because remember, it's like a ski. Top of the hill, it can slide this way or it can slide this way. We don't know which way. You have to see the evidence inside the bar. So we're anticipating, okay, this was a big initiative. Buyers came in very aggressive after this long short. The buyers showed up at this bar. This is a stop loss. Lot of blocks here to support you. All this are supporting you. Now this is an 8 tick stop loss. Right? So if you're waiting only for 4 ticks to come close to you, then buying is here. It never came to your buying, which is fine. Then you wait for next evidence. Every bar you can make money. The problem is you have to get good at it. Now look at this one. Why did it stop here? Look at these blocks of buyers. Huge buyers. Here, moved up here. They were not able to. Now next blocks. This is a huge buyers block. 5 ticks. 1, 2, 3, 4, 5, 6, 7 ticks. Market comes here. You draw the box. You know the level. And you say, okay, I'm going to stop losses here. When they enter this box range, I will enter. You enter 1 or 2, scale in entry of depending on the contracts. And there we go. What happens after that? Boom. Look at that. Huge move, right? This is what it takes to be a 4 tick, 8 tick stop loss trader. And you can achieve this. And again, as we suggest, 90 days it takes for your mind to shift onto a single model of interest. Thank you.